Do not trade a 112 or 111 strategy without first watching and knowing this. This can hurt you and lead you to losing thousands of dollars if you don't understand this correctly. So let me walk you through this. First off, I want to say I'm a big component of the 112 and 111 strategy. So far this year, in the first 22 days of the year, I made $3,100 using the 112 and 111 strategy. That's nearly a 3% return on my money in 22 days. And so I have two 111 trades on right now, making me some good money, but I want to walk you through what is something that a lot of people overlook, especially as we near market all-time highs, where this can play a huge effect and end up you losing a ton of money. So let's walk through this trade. The first thing we need to do is understand the profit and graph chart and what it's really telling us, because it's something that a lot of people do overlook. And so again, if I actually move to the ESM4, which is where I have these two positions on ESM4, and I look at our positions, I'm just going to look at one of the 112s, not both together. So if I zoom out here and look at these positions, we can see here a normal profit graph, if I can get to it, a normal profit graph, which looks like this. However, what most people do not tell you about the 111 and 112 is that this is the profit at expiration. They don't seem to tell you about what happens in the middle of the trade. So we can see here this orange line, it shows us what actually happens throughout the lifetime of this trade. You can see this orange line shows us how our P&L will perform as the trade goes on instead of what actually happens at expiration, because a lot can happen between the difference. As we know, with 101 and 112 trades, we have, so let me get a bigger view. We have this amazing profit graph where if the market drops down, we make $3,000 to $4,000. If the market stays where it is or goes higher, we make roughly $1,000. This is a great setup. That's not actually how it plays out while we are in the trade. And why is this important to know? Well, because your stop loss could get hit before you actually see a profit. What do I mean by that? The market could shrink into this bear trap, but we could still be at a 3 or 4 times loss. Okay, so let's look at this orange line. We can see where the market is now. It tells me my estimated profit is $650, which is true. It's roughly where I'm at right now. As the market declines, though, you can see here, if we get to the beginning of the bear trap, it says my profit would now be $657. Why? Well, because the market is decreasing, so these short puts we have is increasing in value, and it's increasing more than our put debit spread is making money, so we'll be losing. That's $657. As we enter the bear trap, we'll be down $1,200. As we continue on into the bear trap, we'll be down almost $6,000, $7,000. And towards the end of the bear trap, down $14,000 in this trade before we ever get to expiration. So a lot of people will be like, oh, I'm fine. As the market drops, I'll be making money. That's not actually true. That's only true at expiration. So now that I'm telling you this, what are some things you need to be aware of? Well, first I'm going to show you one more aspect of this that would lead to you losing more money, and then I'll show you how to protect against this and be more careful with it. Well, as we can see here, if we actually look at more of our profit graphs, when the market drops, our volatility will increase. So if I increase the volatility by, say, 10%, because if we have a decent drop, it will increase by 10%, if not more. I actually have 9% here. We'll just do that. 9% or more. This actually pushes our losses lower. So before, when we were originally here, we were losing $600 at the beginning of the bear trap. Now we're losing $4,600. When we were at the beginning of the bear trap, we were losing around $1,500. Now we're losing $5,500. So what is this saying? It's saying that if volatility, if VIX, if IV shoots up, and the market's dropping, we're going to be experiencing a huge loss. Before we even get to the profit of this bear trap, we will be having to exit for our stop loss. So what does this tell us? This tells us that it's not all sunshine and rainbows with the 112 and 111. This is something you need to be aware of. There is no free money in the market. Although I love these trades, I do these trades, I am aware that if the market starts dropping quickly and IV is increasing, which is what it does when it drops, I'm going to be seeing significant losses on these trades. And so again, by default, I am keeping my trades on where I have my Forex stop loss. So if I have the ability to make $1,000, then I'll be Xing the trade at a $4,000 loss. So you can see here, a $4,000 loss estimated on this trade would be when the stock, before we even hit the bear trap. So I'll be hitting my stop loss before we get to the bear trap based on how this will perform if IV increases by 9%. So this is something to be aware of. Now, how do we prevent against this? Well, when the IV rank is low, for instance, we can see the IV rank is 6.3 right now. We can have a rule where, hey, if IV is under 10, let's not enter the trade. Why? Because when IV is high and we enter these trades, then IV shrinks and we make more money faster, and it gives us less room for IV to increase. So the best way to do this is to enter these trades when IV is high and capitalizing on the IV shrinking or IV declining. So if IV is under 10, you can be like, I'm not going to place a trade, or you just be very careful and understanding that, hey, IV is low, so that means IV can increase quicker, thus increases your loss. There's something you need to be aware of. Also, something to be aware of is the fact that you could also do it in a way where you structure the trade so that you have hedges. What do I mean by that? Well, if we're putting on a trade every single week, and by sometimes we're taking off some profit, so now that we have hedges, these hedges are going to do the opposite. So again, I have another video where I'll be diving deeper into this, but let's say we remove the two short puts. Well, now we have a hedge to the downside, where as the market drops, this orange line is actually increasing. So this orange line increasing is going to help offset any losses from full 112 trades that we have going down. So you can see here the market declining. We have a 112 trade that's going down, but if we have a couple of these hedges still on, then it's actually going to offset those losses and allow us to stay positive. Also, another way to hedge is keeping on these two short puts and selling or closing the short put from the put debit spread. Now we have the chance to make almost $30,000 at expiration, or upwards of $5,000 just from this orange line in the price movement of history, and we push our profit all the way down to this level around 3,300 at expiration, or around 3,400 based on how price is actually trading. So if we do this, we actually structure a hedge that's even better. And so again, by having these hedges, by understanding how IV rank impacts 112 trades, you need to do that to help manage these trades. And so again, as always, I recommend the 111 and 112 trades are very profitable strategies. Always enter when IV increases. It's the best time to put on a trade, and always make sure you have on a few hedges and stop losses to manage these positions. All right, guys, I hope this video helped in understanding the 111 and 112 trade in a more deeper facet, a deeper way to know, hey, just because at expiration it says I have this profit doesn't mean that's what it's going to actually be or look like when the trade is actually going on. All right, guys, thank you for watching this video. Smash that subscribe button, and if you want my trading strategy for the 111 and 112, click the first link in the description to download my free PDF trading guide so you can do these 111 and 112 trades yourself. All right, guys, see you in the next video.